OSFI, which is the regulatory body for Canadian financial institutions, they just came out of the woodwork saying that they should look into tightening the lending criteria for the over-leveraged borrowers. Really? After 2 years of frenzy, you just wake up? Anyway, we'll look into this story in this video. Plus, we received the latest CPI data from the US for the month of December that shows a clear downward trend, and that shows that most likely we will look sub 2% inflation this year in 2023, which is very similar for the Canadian economy as well. And Canadian CPI for the month of December coming this week, which will determine the potential rate hike from the Bank of Canada as well. So all of this we will unpack for you in this video. Stay tuned till the end. Let's go. Welcome back. If you're new to my channel, my name is Yasin Nizami and I make these videos to educate my audience about the real estate market in Canada, particularly in the GTA, as well as some investing strategies, some macroeconomics, some global geopolitics. So if you're interested in any of these topics, consider subscribe. And let's get back to our topic of the day. Well, OSFI, which is the regulatory body for the financial institutions in Canada, they just wake up. They just wake up after 2 years of ups and downs in the real estate industry, now saying that they should look into tightening the lending criteria for over-leveraged borrowers. So the borrowers who have taken a lot of debt compared to their disposable income, they should now look at it and restrict the banks to issue any more credit to those buyers which are likely unable to pay back their debt because their income is simply not enough to pay back that debt. So they just issue some consulting workshops, which means they haven't done anything yet, but they are looking for proposals, and maybe they will introduce some restrictions this year in the mortgage industry, which will further, push the momentum for the real estate downwards. I think these are useless bunch of bureaucrats, because when the real estate market was so hot that the prices were going up like 4% and 5% on monthly basis at some point during the November 2021 and February 2022, these bureaucrats sitting at their offices, they haven't even done anything. They didn't even make any statement about, hey, we're gonna do something to control this craziness. No, nothing, nada. And now after 2 years, when the market has already gone down significantly and have seen, some major corrections already, and finally they just wake up and they're thinking, okay, we gotta do something. We have to control this by introducing more regulations, more policies to restrict the criteria for the lenders to issue any more credit, which will further, of course, deteriorate the situation for the market. Anyway, that's what OSFI is looking into it. But when you look at the CPI information from the US, because US has the influence across the global economies, particularly in Canada, okay? So the US CPI is showing a clear downward trend. 6.5% from 7.1%, so a major correction. But the key point here is if you look at the month-over-month data, that gives you a lot of hint, because the last 6 months of CPI, monthly CPI, that's showing a significant reduction in terms of the momentum, right? So if you average it out for the last 6 months, your CPI in the US, the headline CPI is sub 2%. Or around 2%. So that gives me a hope that if this trend continues in the next 3 or 4 or 5 months, we will likely to see a sub 2% inflation somewhere in the summertime, maybe July, maybe June, or maybe August, assuming nothing major happens. The only risk I see right now is the Chinese economy is reopening itself, which means China is the biggest buyer of commodities. So if the energy prices starts going up, that will skew up the CPI numbers again, because one of the reasons why the CPI is down is basically because of lower energy cost. And that's very much applicable in Canada as well, because if you look at the Canadian month-over-month CPI, that also shows the same story. The last 6 months of CPI from June onwards to November, if you average them out, that's around, less than 2%. And we'll see next week, what CPI figure we see for the month of December. If that continues, if that trend continues, we will likely to see inflation coming right back down in the range of 2 to 3%. Sometime in the summer, again, June, July, August. It really depends, how the month-over-month calculation goes on. There are two risks for Canada. Number one, Stats Canada, I don't trust their models. They come up with very, very weird numbers, which doesn't even make sense. Because when we look at the job numbers last week, the estimated was 5,000. They posted 104,000 jobs. Yeah, we can assume some rounding off errors, but 100,000 jobs overestimated. Like, come on. I don't really trust Stats Canada, to be honest. But even if we trust on their data, that also looks like inflation is coming down on month-over-month basis. If we have another higher CPI reading, which will definitely push Bank of Canada to continue the rate hike program. So the market is expecting another 25 basis points, which is going to be at the end of this month. And that will again push up the variable mortgage rate further up. But the good thing here is, if you look at the bond market, Canadian bond market, so one of the major bond that people look into is the 5-year Treasury bond from the Government of Canada. The yield on the 5-year Treasury came down from 3.4 right on to 3%. So a massive drop in the yield in the bond market, which tells us that the market is anticipating some sort of rate reduction in the future, because bond market always price in. If the bond market is pricing in some sort of monetary policy getting weaker or less stronger, that means the Bank of Canada has to look into this before making any more rate hikes. But again, the data continuously changing. So what data we have today may not be relevant in the next 2 months. So what we are seeing right now, the bond market is telling us, hey guys, we are thinking the Bank of Canada will most likely reduce the rates in the summer or maybe after summer, because we see the economic conditions are so tight, they won't be able to further accelerate the rate hike, because that will trigger a massive recession in the midst of 2023. So that's what bond market is telling us, guys. Again, it's all data. We'll see more data coming up next week after the CPI print, and the tone from the Bank of Canada which will tell us, okay, what is going to happen on January 25th, which is when Bank of Canada will raise another rate hike. So that's what we're seeing right now, guys. And the real estate market is still very tight because we don't have enough inventory. I just signed a deal in Milton where the asking price on a 4-bedroom detached house around $1.4 million. We signed the deal for $1,265. So that's where the prices are. Basically, prices are not moving a lot. They're moving sideways because we don't have an inventory, but we also don't have enough demand as well. And the mortgage criteria is very, very difficult, right? So people are being stress tested at 7% plus. Not many buyers are able to qualify for that, I can tell you. So we'll have to see if the inventory starts going up, which is expected in the spring market. That will certainly put some more downward pressure on the pricing as well. But we'll have to see based upon the data. When the data comes, we'll see, and I will let you know, guys. So you'll be the first one to know for sure. If you like this video, give me a thumbs up, hit subscribe, and I'll see you in my next week video. Take care.